Hi, and welcome to another episode of Finance and Stocks. Today, we're going to talk about Ebitda, a key metric when we analyze companies and when we want to invest not based on just gut feeling or emotions, when we actually want to know the operational efficiency of a company. The metric Ebitda is really important, and that is why I want you to learn more about it. This is kind of an introduction, so we won't dive too deep and keep the video here quite short, but obviously Ebitda is very important. A lot of CEOs love to talk about Ebitda in their annual presentations, the quarterly presentations, etc. So it's a really important KPI that we need to follow when we invest. And when you will hear Ebitda a lot of times, and sometimes Ebitda get confused with the metric net income, so we need to know the difference between Ebitda and the net income, just so we don't get off track when we invest, so to speak, because the Ebitda almost always bigger than the net income, and we need to really analyze deep the financial situation of a company before we invest. That's my approach, at least. So before we continue, I will lay out the way I think about Ebitda and what we will go through today. First, we need to understand why it's called Ebitda, the very letters, and that the E is for earnings, the B is before, I is interest, T is taxes, D is depreciation, and A is amortization. So basically that's what this is. This is earnings before you pay taxes, earnings before you pay back the loans, earnings before depreciation and amortization, which are two metrics that we maybe need to dive a bit deeper in. But basically, if you buy something, for example, machinery for $100,000, you won't have the whole $100,000 in the income statement the specific year. It will depreciate over time. So maybe 10,000 will be in the result for the specific year, and then 10,000 the next year, etc. Depending on how long you're going to use that machinery in the business. And the difference between amortizations and depreciation is if the asset is tangible or non-tangible. So non-tangible assets is amortization, and tangible assets is depreciation. So that's the difference there. I also think when we analyze Ebitda, it can be good to actually compare the data with a real company's income statement, and just so we can see the difference between Ebitda and net income. So that's also something we will do here today. Something to add here is like the Ebitda is a metric that some investors, and some investors really want to back off from it. For example, Warren Buffett, he always said, I'm so tired of all the Ebitda talk. I want the real net income of the company to make my evaluation, the free cash flow, etc. So basically, the good things we get from the Ebitda is the operational efficiencies. And what does that mean? That means that you have a revenue of a company. For example, Netflix has subscription revenue that people pay in every month. Facebook has the ads that they run on the platforms, getting in as a revenue. After the companies have the revenue, they have a cost of revenue, the cost to create the revenues. For example, the cost of revenue is the data centers where the cloud is. Maybe some advertisement is in cost of revenue, even though advertisement can be both cost of revenue and on the operational costs of the company expenses. So basically, a part of the revenue to create that specific revenue, there are cost of revenue in the accounting. After you have the cost of revenue removed, you have to remove the operational expenses also before you reach the earnings here in these metrics. And the operational expenses are basically the ongoing expenses in the company. So it can be salaries are often the biggest one, but it can also be ongoing marketing that isn't like specific for one sale, so basically more ongoing advertisement that are built in. Administration, like the ongoing administration in the company, are also under the operational expenses. And the research and development costs, which is quite big in a lot of big tech. That type of cost are under operational expenses. So first you have the revenue, then you remove the cost of revenue, then you remove the operational expenses, and after that you kind of have the E in Ebitda. So you have the earnings before taxes. And obviously taxes is what it sounds like. Every company pay a lot of taxes, and the tax rate is depending on a couple of things, but obviously there are in different countries different corporate taxes, for example. So let's not complicate it. Most here probably know what taxes is. Then we have interest payments, and basically when you take out the loan, that loan is not free. So if you take a loan that is $100,000 and you have 10% in interest, you have to every year pay additionally $10,000 on that loan to actually fulfill your duty as taking that loan. Obviously, you also have loan repayments every year. So maybe you pay back 4% of the loan every year. So that will over time decrease the interest expense you have. But for example, if you have $100,000 in loans and you repay 4%, the first year you will repay $4,000, and you had the 10% in interest, then it's 10,000 plus 4,000, so the interest is overall 14,000. So yeah, that's a lot of cost that is not accounted for in the Ebitda. So you don't account. So this is earnings before those kind of costs. Then you have after the interest the depreciation. And as we said before, it's when you buy something, you don't take the whole cost at a specific moment. You might have cash bought like machinery or some whatever. You depreciate that cost over a longer time. So if a company has a lot of costs that have to that will affect the income statement over a longer period of time, those costs won't be in the Ebitda, which will make the Ebitda bigger than when those type of costs are accounted for in the income statement and in the real net income. So that is why the Ebitda are often bigger than the net income. Then we have amortization, that is the same, but it's a non-tangible asset like brand. So if you build a strong brand and you make investment in the brand, you will have amortization of that cost over a couple of years, and it works at the same like depreciation, but it's just different type of assets basically. So that's shortly explained what the different letters in Ebitda means. Now we're going to have a real example here, and I'm going to show you the Meta platform's financials. That's Facebook. So let's make myself small here so we can see the income statement. So I've just this is Yahoo Finance. I have the income statement here, and you have I have the annual income statements. So we have 2021, 22, 23, 24, and you can see some nice revenue gains here. We have the latest year, $164 billion $500,000. So they have a lot of revenue. Facebook, let's call them Facebook, it's just easier to say. And here we have, now I'm going to show you how we reach that earnings metric in Ebitda. So here we have the cost of revenue on $30 billion. And in that cost of revenue, we have those type of costs that I described earlier. If we're going to go down, you have the gross profit. So after you remove the gross cost of revenue from total revenue, you have the gross profit. But gross profit isn't enough to reach the earnings, so you need to remove the operational expenses like the salaries, research and development, etc. that I said. So interesting here, you see Facebook has a lot more operational expenses than they have cost of revenue. So after operating expenses are done, we reach the operating income, which is $69 billion. And basically, we continue here where they have the tax and the net income gets smaller, etc. So if we go down here, we can actually find the Ebitda, the metric that we are talking about here. And as you see, the Ebitda for Facebook is $86.876 billion, and compare that to the net income of $62.36 billion. It's a lot bigger, and that is because obviously you did see here they pay a lot of taxes, 8 billion. I mean, the percentage of tax is not that big if compared to like normal companies that is smaller. I mean, it's like it must be 11 or 12%, so it's actually quite low in terms of percent, but the sheer number is big. So that is one type of cost. You also have here among the numbers here the expenses for interest expense, for example. They actually has interest income, so I guess they are investing in some stocks or stocks, etc., which provide them with some good income. So anyway, is it anything here? No, it's just a lot of numbers, but the gist of it here is that obviously Ebitda shows that Meta platforms or Facebook has a great operational efficiencies because they have from the total revenues of $164.5 billion, they actually have $86.9 billion in Ebitda. Then they have some depreciations and amortizations. You can see there when we go from Ebitda to EBIT, you remove the D and the A, there is just $71.4 billion left. So they probably has a lot of costs that are written off. I often use the word written off, but that are in the category amortizations. Because as a brand, as a tech company, as a brand, Facebook maybe don't invest too much in the machinery. They are investing also a lot in the brand, even though lately a lot of these companies actually invest a lot in like data centers, in buildings, etc., just to keep growing their capacity to provide their services. Meta platforms, for example, are having these large language models. They are maybe the biggest in the world, so they need the space. So that type of cost will be here in the A in the and the D in the Ebitda. So that is maybe the most important things I wanted to say today. So what we need to understand here is like how, when you hear a CEO talk about EBITDA and being very fiery about it, oh, we have positive EBITDA, etc. You need to keep in mind that EBITDA doesn't account for some of the investments the company have that still needs to be amortized or depreciated over time. It doesn't account for taxes. It doesn't account for the interest payment, the loans they're gonna get paid back, etc. So if you have a lot of loans as a company and you have invested a lot, you can have a great growing EBITDA, but you can have problems to finance that EBITDA because you have grown too fast. So as an investor, you need to find a connection between the EBITDA and the net income and those things between, just so you don't make a big mistake. And I have many times, especially with smaller companies, which often have higher rates, interest rates, etc. I have seen and listened to the earnings calls, and they have talked about the growing EBITDA, and the EBITDA seems so fine, it keeps growing, but the net income never seems to take off. And maybe after a couple of years, we still don't see the net income. So basically, they have problems to grow without growing their debt. They have to loan more money to keep growing, which can be a problem. So you want really that EBITDA to be big enough so you can repay your loans and have a real net income on the bottom that you can reinvest in the company over time. So that is why the biggest company are in the driver's seat, because they have so much cash on hand. They can really leverage that to keep growing and take market share. And I think that might be the reason why, if you know the indexes like the Russell 2000 and 3000, with a lot of smaller companies, after the COVID, they have had some problems to keep up with the Nasdaq, for example. So I have personally have some great smaller companies in my portfolio that has performed very good in terms of execution, but not the stock price, because they have problem just to reach that net income on the bottom line. So keep all these metrics, KPIs in check, and improve your understanding here, because you don't want to make a mistake when you listen to CEOs talking about the companies, because EBITDA sure is a great thing, but you also need to know what's the difference between EBITDA and net income. I just want you to have the best opportunities out there to grow your portfolio and feel secure long term in your investments. Because you don't want to be scared when your company maybe is 10% down after earnings call. You need to know your numbers and keep calm, so you know when you should buy more of your stock and when you should sell. And you need to be forthcoming and see the writings on the wall before Wall Street does. So yeah, that is what I think. Anyway, that was the topic for today. I hope you learned a bit more about EBITDA and why it's important to understand operational efficiency, etc. So yeah, thanks and bye bye.